Okay. Now, the way I look at equity investments, when you choose the best of stock to invest, which can give you a very supernormal return, it's a very challenging task. There are no shortcuts. Firstly, students should understand that forecasting ability is much more important as compared to the ability to merely scan through the financial statements, the PL account, balance sheet. You got to have an idea about the economy, an idea about the industry, and then you come down to the balance sheet and PL account level. Let me share my short insights with you. When I look at a company, whether it is a good company to invest or not a good company to invest, the first thing that I look at is the management of the company. It is the management which is running the company which is taking the decision. I look at the legacy of the management, whether they have a proven track record of managing the company well in coming out of a distress situation. So companies like Tisco, okay, backed by Tata Group, companies having the Birla Group backing, they are the companies which have a solid management and where we can rely on both, number one, integrity, that they are honest, they want to reward shareholders, and number two, competence, that they have the caliber to actually create value for the shareholders. So integrity and competence of the management, think about those two terms. Once I am satisfied that yes, the management of the company is good, in that case, the second thing that I look upon is the business, the scalability of the business. There are certain sectors in the economy which are growing at a growth rate faster than the GDP growth rate, while there are certain sectors of the economy which are growing at a growth rate less than the GDP growth rate. We got to identify those sectors which will outperform the economy. So I look at the business, is the business scalable? What is the competition in the business? How much is the demand for the product? How much is the supply? Who are the other competitors? What is the pricing pressure going on? You must be knowing, or you should be knowing, that the best way to analyze the competitive structure of an industry is the Michael Porter's competitive analysis, in which we look at the threat of entry, the bargaining power of buyers, the bargaining power of suppliers, the threat from new substitutes, and the rivalry among firms. So Michael Porter's analysis should be carried out to see whether the industry has low competition or high competition. You must be knowing that we prefer to invest in that industry where competition is low, because if competition is low, profitability is high, and if competition is high, profitability is low. So choose an industry jahan pe there are entry barriers, other players are not able to enter. Okay, so existing players will be able to make profit. So first is management, second is business, because the management cannot make the business profitable. And the third point is valuation. Good management, good business, but is the stock trading cheap? A good company may not be a good investment. Reliance is one of the best of companies in the world, but perhaps the share price of Reliance may be overpriced. It may be on the higher side as compared to what the intrinsic value commands. So you got to look at valuation as the third and final play. Valuation could be done by various methods like dividend discount model, like price earning ratio approach, even option pricing approach. So that's too detailed for me to provide an insight. But my point was that you should not ever confuse between a good company and a good investment. A good company may be a bad investment because the price is higher. The price is higher. A bad company may be a good investment because the price is lower. So look at the management, look at the business, and then look at the valuation. Okay, that is how one should go about in choosing the best companies. Students at this level may be thinking very myopic, short term. For instance, how do we identify a stock which will provide a supernormal return the next day or the next month? This is not about equity investment. Equity investment is a buy and hold long-term passive strategy, the Warren Buffett style. So you have to identify a stock, hold it on. If your forecasts were correct, sooner or later the market will agree to it and you will make a handsome, phenomenal wealth gain. But that patience has to be there. When you start investing in the market, the patience is not there. When we see losses, we are not able to cut the losses. Okay, while trading, we make them bigger and bigger. When we see profits, at the first instance of a profit, we book the profits. The profits are always smaller, losses are always bigger. It's a sheer case of wealth destruction. So a lot of insights are there in that regard. Okay, so think about the same.